Alright, well, welcome to Chapter 6, where we'll discuss some income or losses from business, so business income discussions. When we talk about business income being defined, the Income Tax Act specifies professions, manufacturers, trade, or any other undertaking given by a certain business, but it can be more explicitly talked about being a self-sustaining, integrated set of activities and assets conducted and managed for the purpose of providing a return to investors. So it's taking inputs and taking those inputs and creating outputs that are used to generate revenue. Specifically, we'll talk about some of the basic rules, what's included for business income when calculating for tax purposes, and then there are some limitations and deductions that we'll walk through in Chapter 6. It is important to note, if you reflect back on Chapter 3, where we talk about employment income, that there is some significant consideration needed to be made in justifying whether it's business income or employment income and expenses related to earning employment income. So just keep that in mind as we walk through this chapter. And some of the other considerations to make are when you're determining income split between business versus property income. Business income has certain deductions that can be applied against it versus property income does not, as well as CCA, so capital cost allowance recorded due to owning property, can't create a loss for the organization. So this little chart on page 245 that gives you an example of where you have business income versus property income, and specifically where you have property that's used in the business versus acquired as an investment, will help determine what category of income that it's included in. Another consideration is specifically around business income versus capital gains, is that capital gains are only taxed at half the rate, being about 26% overall instead of 52% tax rate. And capital losses, they're only half deductible, but can only be applied against capital gains, whether they're carried back or carried forward. One example around capital gains or losses, it's where they result in the disposition or the disposal of a capital asset. Capital assets were required to help produce income throughout their useful life. However, if that capital asset or that item was purchased for inventory to be resold, it would have been an inventory item. So just to keep that in mind when you buy an asset, to determine whether it's actually a capital asset versus an inventory item. Lastly, some considerations. It talks about intent. So whether it's an item that's reflected in your business income or loss versus a capital asset. Considerations can include, length of ownership of that said asset. How frequent are these transactions related to these assets? What's the relationship to the taxpayer's business? Is there any additional work made on that property to potentially enhance the value or marketability of that asset? And what's the nature of the assets? So was it used in some cases, was it used to produce income, or was it used as an investment to help you provide service delivery or set up a manufacturing process per se? Firstly, let's reflect on GAAP, the generally accepted accounting principles, and the fact how similar they are with business income. They're both done on an accrual concept and on a net basis. Now we'll talk about differences. Some of the major differences for business income versus GAAP accounting, specifically around amortization or depreciation. You'll have one set of accounting policies in place for amortization of your capital assets. However, your capital cost allowance very often differ from it, as we talked about in Chapter 5. Sometimes you have other allocations, such as pension costs, that you may deduct funding payments for tax purposes, but actually there's an accrual component for accounting purposes. Another example would be warranty costs, where only cash payments are deducted for tax purposes. Sometimes there are permanent differences, very often, and the biggest example being capital gains, where only 1/2 is reflected in income for tax purposes, but 100% would be reflected in the financial statements. Other situations might be around unreasonable expenses, such as luxury travel costs, so where you're paying, first class air travel, or a super high-end hotel or accommodations that would not typically be justifiable for business purposes. Some of those items are backed out for tax purposes. Another examples are non-arm's length transactions. So an example might be you pay somebody that's related to the company a salary higher than would be justified for a position. That amount exceeding would not be deductible for income tax purposes. So those are some examples of the major differences between the two. Another inclusion in business income specifically talks about amounts received or receivable. So if a customer, say, gave you a deposit on an order, but you haven't yet received the goods or delivered the goods to the customer, for tax purposes, it would be considered as income because you have the cash on hand. However, the next conversation will talk about reserves and how that is deducted in another manner. So then we talk about reserves, where you have the ability under tax purposes to add an additional expense for future related activities or transactions. Specifically in this chapter, we'll talk about three areas, being doubtful debts or bad debts, undeliverable goods and services, and unpaid amounts. Okay, we'll go through a little example for bad debts, and we have this example where December 31st, 2019, this company estimated that $2,000 of its $50,000 in accounts receivable will be uncollectibles. Under Income Tax Act Section 20, they could deduct $2,000 as a reserve for bad debts. Then as they moved on into 2020, they wrote off a total of $2,200. So under Income Tax Act Section 20, they would deduct the $2,200 from their business income. And then on December 31st, 2020, they'll estimate that $2,500 of the $62,500 in AR will be uncollectible. So under Income Tax Act Section 12, they need to add back to income the prior year reserve of $2,000. Under Section 20, they will deduct the current year reserve for bad debts being $2,500, resulting in an overall deduction for the year of $2,700. Same kind of net result as accounting purposes, being allowance for doubtful accounts, but a slightly different application on how it's applied and recorded. Now let's talk about undeliverable goods under Income Tax Act Section 20, where we have receipts in the year of 2020 of $300,000, however $40,000 for goods to be delivered next year. So under Section 12 of the Income Tax Act, we will include $300,000 in business income, but under Section 20, we'll deduct the $40,000 of cash receipts for the goods that will be delivered next year. All right, in this example, we're talking about unpaid amounts. So our customer pays the full sales price in future periods. In this situation, they sold an item for $300,000. Cost of that item to us was $200,000 for a gross profit of $100,000. And this customer will be paying those amounts over the next 4 years. So when we close up the 2020 year, we can actually record a reserve of the full $100,000 gross profit because it actually was not paid yet from the customer. And then it'll be amortized over the next couple of years to earn 1 quarter based on the 4 annual payments. So the following year will be $75,000, following year $50,000. However, you cannot carry the reserves for more than 36 months. So at the end of the 3rd year later, being 2023, the reserve will drop to 0 at that point. Some other considerations for inclusion of business income are around lottery winnings, various miscellaneous receipts and income losses from crime, and there are some specific examples on page 256 of some of these other sources of business income that would be considered business income, with the exception of lottery winnings generally not being taxable. Lastly, some other items to include in business income talk about damage payments received, so typically where you're awarded through court. Payment. It depends on the resolution. So if the payment is received from another party that's intended to replace income, then it's typically earned as business income. But if it's compensation for damages due to reputation or the like, they're typically not. It's a tax-free capital receipt. Debt forgiveness, it depends on the situation. It's very complex, and it talks about Income Tax Section 80 in more detail. But in most cases, it would be taxable because the person that had those assets was able to claim the interest expense on that debt in the previous period. So any income earned through debt forgiveness would usually be used to reduce loss carryover balances. Government assistance depends on the situation. If you receive government assistance that helps to offset current revenue expenses, it'll be included in current income. However, if it's included to buy or purchase capital assets, It's typically netted against the cost or the acquisition cost of those said assets. Inducement receipts are typically around leaseholds. So if a landlord were to give you an inducement, a rebate or a reduction of your lease payments in order to take over space, you would typically receive that as current income if it's to be used to reduce any related costs or related expenses to move into that space. On restrictive covenant receipts, typically it's an undertaking made or the waiver of an advantage or right by a taxpayer. And very often under Income Tax Act Section 56, these payments are expected to be included in income. However, there are some exceptions. All right, so some of the limitations around business and property income. Talk about what you can or cannot include for expenses incurred in order to produce income. So lots of details on page 257 to 260 in the textbook. But specifically, your expenses must have been incurred in order to produce income. You cannot include capital expenditures because they're recorded in a separate way, as we covered in Chapter 5. You can't include expenses for exempt income. So say you won lottery winnings, it's exempt income, but you can't expense the purchase of that said lottery ticket. Cannot include personal expenditures, groceries for your family. No deferred income plans, no rec or club dues, and no political contributions. They're all treated in separate ways. So again, lots more detail if you want in the textbook to explain that, but that's in general some of the limitations. A few additional limitations are around personal services, business expenses, excess automobile mileage. So there's maximums allowed to reimburse employees for mileage, being 59 cents on the first 5,000 kilometers in a year and 53 cents after. Many organizations are well underneath these rates, but you cannot deduct amounts over those rates. Interest and property tax on land are specifically dependent upon what the land is being held for. And again, a little more detail on page 259, where it talks about payments on land that's held to produce income could be considered income for the business or property income versus if it's not. Soft costs, so this is where we talk about construction. So there are expenses incurred during a period of time, perhaps to build space. You would be added to the cost of the property, not expensed in the period incurred. Thin capitalization is quite a complex situation where, depending on an owner, if they hold debt and equity of their business, there's limitations in place to determine how much interest they can expense or not expense against their business income in the organization. So a couple great examples on page 260, 261 that walk through that. And you cannot include prepaid expenses for the year. So it's the same kind of treatment as GAAP. All right, another great spot, and you'll have lots of questions from people, I'm sure, about workspace and home, especially during the COVID in the past year. And the CRA did implement a short version, T77S, where they could just apply $2 per day as a tax credit to be considered. But ongoing before that and always is a possibility of deductibility of workspace in the home. So it depends whether you're an employee or a self-employed business income on what is deductible. There's a great chart on page 262 of the textbook that walks through the various expenses you would incur to operate a house and what could be deductible. The important part is to note that everything in these categories is all pro rata. So it looks at the percentage or the square footage of your house used for your home office versus this total square footage of the home, as well as the percentage used time-wise compared to 100% time. It is very strongly recommended that CCA, so capital cost allowance on the house, is usually a bad idea because in the future when you sold the house you would actually have to pay a gains tax on a percentage of that capital gain related to the space that you've worked for. So I know from my tax clients I always recommend not to take CCA on a home. Some other restrictions specifically talk about foreign media advertising, and it depends on the intent. So was it printed and focused on the Canadian market or non-Canadian market? So the Income Tax Section 19 was added to specifically talk about print media in the foreign areas. It also includes whether it's directed at Canadian market or not, if it's provided 80% or more, if it's non-advertising content, is original editorial content. That means it's created by an author that's been paid for that specific item. And if so, then it can be determined whether it's deductible or not. So again, more details on page 263, but something to consider. There are some restrictions when you're spending money outside of the Canadian economy. One of the other considerations is around reasonableness. So any expense that's being recorded must be reasonable. So if you look at income tax section 67, it was added to add this philosophy. So a couple of examples are, an example is on page 264, where it talks about sole shareholder of a private corporation appoints his 6-month-old daughter as VP of the corporation and pays her $100,000 salary. Yeah, as the services of the 6-month-old are extremely unlikely to have any business value, this $100,000 would be disallowed on the grounds of it being unreasonable in the circumstances. So hopefully that paints the picture of what people have attempted in the past. All right, one specific area of reduction for tax income purposes is around business meals and entertainment, that only 50%, one half, is deductible. The rest of it is lost. It's no longer, it's not a carry forward, carry back for any purposes for income taxes. There are some exceptions where, say you provide a meal to a customer for a fee, obviously that's fully deductible. Costs for fundraising events, any reimbursed costs or costs employees at a remote work location, or costs incurred for all employees at special events. So it can't just be, you took somebody out for a performance review over lunch, only half of that would be deductible for income tax purposes. Next topic is around automobile costs and what's able to be deducted for income tax purposes. It can be interest expense, capital cost allowance, and specifically leasing costs. And so specifically around interest expense on an owned vehicle, it looks at the lesser of interest paid for the year, or $10 per day is the maximum allowed. Don't forget what we talked about in Chapter 5, being where there are two different classes, where there are cars less than $30,000 in cost in Class 10 and vehicles over $30,000 in Class 10.1. When we're talking about leasing costs, it's limited to a prescribed amount of $800 a month, and there are two different formula to apply and to consider to determine what applies. There's the basic formula, cumulative formula, which looks at that maximum $800 per month, and there's the anti-avoidance formula, which focuses on vehicles that basically exceed $30,000 threshold in cost. Details on the formulas are on page 266 and 267, and I will say in real life practicality, when you're recording these transactions in tax software, etc., to do the calculations, it'll spit out the proper formula for you. Firstly, about the basic formula, cumulative amount looks at the prescribed amount, which is $800 as of 2020 year, times the number of days since the beginning of the term divided by 30, less the total amounts deducted in the previous years, less the notional amount of interest since the inception of the lease, calculated at the prescribed rate, anything over the $1,000, less item E being the total of all reimbursements that became receivable before the end of the year in related to the lease. The anti-avoidance formula, which is an annual calculation in this case versus cumulative calculation, looks at the total of actual lease charges for that year that was just passed and paid, times the prescribed amount, which is for $30,000 for vehicles leased in 01 to 2020, divided by 85% of the greater of that prescribed amount. So C is that 35,294 number, so it's a fixed figure as of this point. And then from there you take away the notional amount of interest for the current year, anything over the $1,000, and you take away any reimbursements at that point in time. One other consideration under section 67.5 and 67.5 and 67.6 is that fines, penalties, and illegal payments are generally not deductible. So for example, you're a courier company, you get parking tickets, you can't deduct them, or if you get a fine for filing your corporate income tax return late, those are not deductible for income tax purposes. Alright, when it comes to leasing property, GAAP very often requires many leases to be capital leases instead of operating. However, under the Income Tax Act, a lease is a lease, no matter what. There's no capitalization. However, there are some situations under Income Tax Act Section 16.1 where it does talk about the option where both the lessee and the lessor can elect to capitalize that item, that lease property. However, it is quite a rarity. This difference can create a significant difference between accounting income and tax income, because one is just a pure expense in the period, and the other one, it's a capital lease with an imputed amortization of those lease payments over time. When it comes to inventory valuation, it's very much the same as what you would do in accounting. However, for taxes, you have two options. It's the lower of cost or market, or you can simply update your inventory based on market cost of that said inventory. To determine the cost, it's through the same three manners of inventory tracking, whether it's specific identification, average cost, or FIFO, first in, first out. However, LIFO can't be used for tax purposes either. Depreciation inventories is not covered in this textbook or this course. However, it is mentioned just for your information in case you ever come up in one of those situations. The next number of slides talk about some specific deductions. This slide is specifically around you cannot deduct capital costs. As we talked about in Chapter 5, there's CCA. Incorporation costs are only deductible up to the first $3,000, otherwise they're capitalized. And interest in this example must be incurred in order to produce income. Financing costs are specifically around the issuance of shares or incurred on the borrowing of funds, and they must be deducted on a straight line basis over 5 years. Another specific deduction is around discount on debt obligations, so where you issue a bond where there's a discount incurred, and typically it's only up to 97% of the maturity value. If the yield's less than 4/3 of the coupon value, then you conduct the full amount at maturity. It's not amortized like it is for accounting purposes. Otherwise, there'll be a capital loss at the maturity date, and at that point, because it's a capital loss, only half of it's deductible. When it talks about repayment of shareholder loans, that is not covered until Chapter 15. But if a loan to shareholder is carried on the balance sheet for 2 consecutive year ends, the principal amount must be added to the income of the borrower. Otherwise, we covered a little bit about reserves earlier on, but specifically around doubtful debts or bad debts for accounts receivable, the undelivered goods, warranties, and unpaid amounts, as we talked about previously. There are specific deduction processes. Some other areas are bad debt write-offs, so actually what you did write off for the year is deductible. RPP contributions, registered pension plans, more detail in Chapter 10, but it's specifically about what is paid in that calendar year or fiscal year being reported for your corporation tax return. Under the deferred profit sharing plan, it's only amounts that are paid, not accrued, that can be deducted. Lease cancellations are typically, you cannot deduct them right away. However, it's amortized over the remaining term of the lease, including any renewal periods. And landscaping, without this exclusion or section 21AA, you would actually have to add it to a capital cost of the organization. So this allows you to write off landscaping costs as an expense for the business. And lastly, we won't go too much into detail at all in our examples either, but some other specific deductions talk about representation. It's in section 21CC, and then we got section DD for the cost of investigation of sites, etc. Salary deferrals, disability related costs. So there are many other tax specific items. So rather than getting into too much detail at this point, it's a matter of making you aware, and in that case, then you would look it up if it were to apply to the situation. Now for a taxation year for business income, for corporations, it's always their fiscal period that cannot exceed 53 weeks, so it can have a start and end date at any point in the year for that full year. For unincorporated businesses, it's typically easier to use the calendar year because the income is reported on individual returns. But you can use a fiscal year. The problem is because it's an unincorporated business, the way it's taxed through your personal income tax returns, T1 schedules, you'd actually cause a lot of additional work to determine what's actually income for that period. So it's always better to use the calendar year for unincorporated businesses. One specific area discussed is around farm losses. If you're a full-time farmer, losses are fully deductible against any other source of income that farmer may have. If you're considered a hobby farmer, no losses are deductible. It's just part of your personal living. If you're a part-time farmer, it's restricted with a carryover allowed. So the first $2,500 of loss is applicable to other sources of income, and then up to half of the next $30,000 of loss. So you're only allowed to claim a loss of up to $17,500 per year. When it comes to income of professionals, in the past, it's always, there's been two buckets, a full accrual and a billed basis. However, the billed basis is being phased out over the next few years. So by 2022, it'll all be on the full accrual basis. So based on hours of effort, not what's been billed or what's been paid by the customers. Specifically, those affected by this change are accountants, dentists, doctors, lawyers, vets, and chiropractors, where they could report their income only what's based on what was billed. And the billed basis was not available to architects, engineers, or management consultants. So it was all full accrual. Due to the migration of billed basis to full accrual, there is a 4-year phase-in process starting in the 2018 calendar year, where those affected organizations would slowly earn their unbilled receivables as income in those 4 said years. So by 2022 filing, 100% of all their unbilled receivables would be considered as income in the year that they actually perform the services. And one other example to talk about before we wrap up this chapter is around ceasing to carry on business and whether it's a sale of a capital asset or not. So sections 22 to 25 all contain provisions that apply for when a person sells all their assets or a substantial portion of their assets used to carry on a business. And it specifically talks about inventory versus accounts receivable or other capital components and determine the nature of what asset is being sold off to determine whether it's business income or capital gain. And a short example around the section 22, where a vendor has receivables at face value $25,000, a fair value of $20,000, so what we think that was collectible is $20,000, and the actual collections are $20,000, and he's deducted a reserve of $3,000. So if they make no election between them, the vendor would add $500 to income, being the difference of the reserve $3,000 less 1/2 of the actual loss, because he's only getting paid $20,000 from the buyer for the $25,000 asset, so therefore he'd add $500 in income. The purchaser would record the asset, the AR, at $20,000 based on that fair value, and would record any capital gain or loss if they collect something different than the $20,000. If they elect under that section 22, the vendor would deduct $2,000, so the difference of the reserve of $3,000 and the actual loss of $5,000. And the purchaser can add a reserve if they want, and they'll deduct any actual in the future. So it just talks about how it shifts between the two organizations. And that's just a short highlight on Chapter 6. Again, lots more details in the book or online on my lab. And otherwise, we'll see you later.